Most traders look at SMT only when liquidity is taken out of one of the assets. They wait for one instrument to update its maximum or minimum, while the other fails to do so, and that's where the analysis ends. But correlation is not just a momentary signal. It's a way to understand which asset is beginning to lose strength and which is continuing to move, even before it becomes obvious on a single chart. The correlation between two instruments is not confirmation of manipulation, but a tool for reading relative strength. And if you use it correctly, it can become your advantage because you begin to see weakness before it appears structurally. In this video, I won't go over the basic application of SMT. I want to take a deeper look at how to analyze two charts simultaneously, how to identify strong and weak assets, and how to use this difference in your trading. For me, working with strong and weak assets is not an additional tool, but an integral part of the trading system. Very often, when you look at only one asset, you see the structure, liquidity, and possible target, and it seems to you that the picture is completely clear. But without comparing it to a stronger asset, this analysis may be incomplete, and that is exactly what I want to demonstrate now. Let's start with the EURUSD chart. We see how the price reaches a strong liquidity pool, the previous weekly low. Then a reaction appears. It's also worth noting the inversion that forms immediately after the liquidity is taken out. Another important point is that the downward movement towards this target was quite compressed, which means that this compression could potentially become a target for longs after the previous weekly low is realized. If we put all these variables together, the picture looks quite convincing. The withdrawal of a significant liquidity pool, a reaction with the formation of an inversion, and the presence of a potential target for longs in the form of compression. Analyzing only this chart, most traders will likely lean towards looking for longs rather than continuing shorts. If you see it differently, write in the comments. I'm interested to hear your opinion. It would be logical to wait for the inversion zone to be tested and then consider buying. But as we can see below, the decline continues. This raises a logical question. If all variables pointed to possible growth, why did the market continue to fall? To answer this question, now let's look at a stronger asset, the DXY. So let's open the DXY chart for the same day and begin a sequential analysis. The first thing that immediately catches the eye is that the target in the form of the previous weekly high has not been removed. It is significantly higher than the current price. In other words, key liquidity on the stronger asset has not yet been realized. The decline we see on the DXY is just a reaction from the zone of interest, in this case, from the short fair value gap. Moreover, the next day, the Asian session opens with an aggressive long movement. Yes, there is also compression from below, but the main point is different. The asset has not yet realized its main goal of removing liquidity and is only moving towards it. Meanwhile, the weaker asset, EURUSD, has already achieved this goal. This is where the analysis becomes more complete. The withdrawal of strong liquidity on EURUSD no longer looks valid on its own because the stronger asset has not yet completed its movement. If DXY is heading towards the previous weekly high, then the pressure on EURUSD is likely to continue. When you analyze both charts at the same time, it becomes clear that it is premature to consider longs on EURUSD in this situation. The DXY provides a more complete picture and shows that the main movement is not yet complete. And here it's not so important whether you are trading the dollar index itself. It's much more important that the analysis of two correlated assets allows you to avoid a trade that looks logical on one chart. Now let's take a step-by-step look at the situation in real time on the NASDAQ and see how our understanding of the chart changes after analyzing the S&P 500. To make it more interesting, let's start with a weak asset, the NASDAQ. On the chart, we immediately mark the upper and lower boundaries, the maximum and minimum with which the price has not yet fully interacted. Within this range, there have already been local liquidity withdrawals, but the market has not yet worked with more significant pools. This means that the main targets are still relevant. Additionally, we see that the price is trading within the daily short fair value gap zone, which is currently holding the movement. Until this zone is inverted, it's premature to talk about priority longs. Based on the current structure, a movement towards one of the two extreme targets seems more logical. Now let's look at a stronger asset, the S&P 500, and see if it confirms this scenario or changes our perception of the current situation. The picture looks different on the S&P 500. On the stronger asset, we are already seeing liquidity being removed from the upper limit of the range. This withdrawal was followed by a short reaction, bringing the price to the liquidity zone of last month's low. From this zone, the market reacted again and began to move towards last month's high, but this target has not yet been achieved. Additionally, it's worth considering the daily short fair value gap, which is currently holding the price. However, there's an important detail here. Last month's low has already been removed, and this did not lead to a full continuation downward. In other words, significant sell-side liquidity has already been realized, but last month's high remains untouched. In this situation, I would highlight equal lows as the main current target. After they are realized, it makes sense to see how the market will react to this withdrawal of liquidity. In this context, I wouldn't expect a deeper delivery of the price to the lower targets. And that is why, given that the S&P 500 is a stronger asset, working on the NASDAQ at a lower target doesn't seem relevant to me at the moment. If a strong asset doesn't show a willingness to continue moving down, then it's premature to look for aggressive shorts on a weak asset. This is where correlation begins to work to your advantage, because analyzing only one chart would not provide such clarity. I wanted to show you that asset correlation is not just about removing liquidity and looking for divergence. It's about getting a more complete picture of the market. When you analyze two instruments simultaneously, the real goals of the movement, priority targets, and which asset is really driving the market become clearer. Correlation helps not only to find an entry point, but also to understand the logic of the movement. If you find it difficult to build such an analysis on your own and determine which asset is stronger and which is weaker, you can use the OWL trend indicator. This is not a smart money tool, but a full-fledged trading system that helps you work in the direction of the current trend, determines entry points, and reduces subjectivity in decision-making. It doesn't replace analysis, but it can be a good support, especially if you are still developing a systematic approach to trading. As always, I'll leave the link in the description. It's even easier to apply this approach in the cryptocurrency market. You always have one main asset, Bitcoin. It is Bitcoin that sets the overall momentum and direction for the entire market. So when you analyze any altcoin, it makes sense at first to understand what goals the stronger asset has, where the liquidity for Bitcoin is, and what scenario is currently a priority. Only after that does it make sense to move on to the chart of the coin you plan to trade. Because if Bitcoin is moving towards significant liquidity or is in an active phase of movement, most altcoins will follow it. This approach allows you to avoid trades against the overall market momentum and gives you a clearer picture when you choose a direction. To trade cryptocurrency, I use the Evedex exchange. It's a decentralized platform for trading derivatives without KYC, with fast execution and low commissions, which is especially important when you work with intraday and swing models. If you're actively trading altcoins or Bitcoin, having a convenient infrastructure is just as important as the analysis itself. I'll leave a link to the exchange in the description below the video. In conclusion, I want you to take away one simple idea from this video. Correlation is not an additional filter or instant confirmation. It is a way to see the market more broadly. When you analyze only one chart, you are always looking at part of the picture. But when you understand which asset is leading the movement and which is lagging behind, you begin to see the real direction of capital. Correlation is not about complicating analysis. It's about advantages. And it's precisely these advantages that form a stable result in the long run. If you found this video useful, please support it with a like and a subscription. Next, we'll look at things that give you an understanding of movement, not just nice entry points.